Mike Tedeschi, Wealth Management Advisor at Perspective Wealth Planning. With this week's market breakdown video, we're going to take a look at the four major U.S. indexes. We're also going to take a look at the U.S. dollar and its impacts on some commodities, gold, oil, silver. And we're also going to take a look at the S&P 500 percentage of stocks trading above their 200-day moving average and what that could mean for us when we put it in the context of sentiment. Let's jump right into it here. What we have up on the chart this week is a weekly chart of the S&P 500. And you can see on a weekly basis, we continue to talk about this major resistance zone right in here was that gap down from earlier this year. And for the last couple of weeks, the S&P 500 has come up and kind of pushed into that zone and been rejected from it. And we're actually back down right around that 3,200 level right now, which is really a zone that we'd like to stay above. Okay, so what happens right here is very, very important as we run up into this gap. If we continue to get rejected and fall back below 3,200, that really does open up the potential for us to go back once again to the bottom of that range that we've been trading in since May, which would be that 3,000 level. So we're really closely watching what's going on right here. When we take a look at the Dow Jones, very similar setup here. The gap is much higher than on the S&P 500. As we've discussed, the Dow has been a lot weaker than the S&P 500. You can see the gap's all the way back up here. We haven't even pushed into that. Where we have failed is right at the important resistance level from back in July and October last year before we had that breakout. That has acted as resistance a few months back, and this time on this push-up, we couldn't even get back to that level. So what we have out of the Dow is lower highs, all right? And what the bulls really want to see happen here is the Dow get up over that 27,000 level and really get up over that high from June before we can really say that the strength is in this space in the market. The next support is back down here at that 2,500 level, so we're going to continue to pay close attention to what's going on over there. And when we take a look in at the Russell 2000 here, right, we've talked about the 50s as being the key. All right, so the 1550 zone was the resistance from June. 1450 is in the middle of that range, and 1350 is all the way back down here at the bottom of that range. Just like the Dow, we have lower highs. We couldn't get over that 1550 in June, and now this push up here this week and last week is right at that 1500 level, so about 50 points lower. So really, again, what the bulls really want to see happen here is just to get up over that 1500 and back to that 1550 level and get above that zone, really, if we're going to continue to see a push higher. Lower highs, failure, and a head back lower would target that 1350, and it'll also be very bad for the bulls here. The Nasdaq continues to be the strongest. We have talked about this many, many times. Has continued to make new highs after new highs. And when we come in here over the last couple of weeks, last week, we almost made a new high, but not quite. And this week, we've had a very small range in comparison to the other indexes out of the Nasdaq here. Really, what you're looking for is us to hold over that 10,500 level. If not, we do get that back test around that 9,700, which would, if you think about it, be a breakout and a back test. And then the next move would be the most important. We'd either get a break to new highs, or we would end up having this be a failed breakout. So on the NASDAQ, for me, the most important level is really testing that breakout back at that 9,700 level. And for real strength to continue to stay right now, would be to hold over that 10,500 level. Now, let's take a look in at some commodities. First, let's take a look at oil. When we jump in here and take a look at oil, we have had a big rally off of the bottom, but we have failed right at that gap down from earlier this year in March. And if I extend this line out here to the left, you can see the very important level of that 42-ish zone in on oil. It has been important now for 5 years. All right. So we had the importance here, 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 and then when we broke underneath of it, now we're testing it from the underside. And this week, we're starting to finally see a little bit of a move down. Bulls really need to hold on to this zone and continue to push higher. A failure right at this resistance point and a move back lower would be very bad for oil, and that probably would not do great for the energy sector of the S&P 500. So that could be a lag on the overall indexes as well. So we're going to pay very close attention to what happens to oil here. Now, the commodities that have looked the best as of late have been the precious metals. I will back gold up and actually look at this in on a monthly chart. You can see, boom, we have made a new all-time high here this week out of gold. Just shy of that 2000 level, but really, really strong action. We have been all over this here for a while. We'll continue to pay attention. The silver, if you've noticed, these lines have stayed on the chart for quite some time. We talked about the next resistance level on silver being at 26 level, in which that goes all the way back to the breakdown in 2013. And where did we stop this week? We can zoom in here and look at this on a daily chart. We stopped right at that 26 level. So silver bulls really wanted to see a push up above it, but a huge move all the way up into that resistance zone, a little bit of a pullback and some sideways action here would be constructive and would be healthy. We really do need to get back up over that 26 level, and then our next target on silver would come all the way in there in the mid 30s. Now, of course, when we're talking about commodities, we also want to pay attention to the US dollar, and that has become under pressure here as of late. We talked about the real importance here at that 96 level. Again, this is a monthly chart here. We have broken underneath of it. I'm going to zoom in here and take a look at it on a weekly time frame for you guys. So real weak action there out of the US dollar, and our next support really comes in at that 91 level. As always, since commodities are priced, we're looking at the price in US dollars. A weaker US dollar typically is a tailwind for commodity prices. So we're really going to continue to pay attention to this. This also can have some big impact out of the emerging markets as well. So the weakness here out of the US dollar over the last couple of weeks certainly has probably helped that rally in precious metals. So if the dollar continues to stay weak, that would be another tailwind for your gold and your silver moving forward. So we'll continue to really pay close attention here to the US dollar. Now I want to come in and take a look at our smart money, dumb money confidence indicator. As we have continued to talk about, the spread between them has been wide, but the interesting thing was smart money was hovering around this 50 zone. And really, we hadn't had that big divergence like we usually see in terms of when markets ultimately usually end up or close to making some sort of a reversal. However, now we are kind of seeing that as smart money has continued to drop and dumb money has continued to stay extremely confident here. And we're going to take a look at what this means in the context of our current breadth readings out of the S&P. What I have up here is a look at the S&P 500 and then the stocks that are trading above their 200-day moving average on a percentage basis. And what you can see from this chart is we really have issue when we stay underneath that 60% zone. And that right here is what we typically tend to see in those kind of larger pullbacks. This chart, by the way, goes back to 2010, so really the last decade. You'll notice that that push in June actually pushed us above that 60, but subsequently on this push, we're not seeing that. We're still below that 60% of stocks underneath the 200-day moving average, which means we're not getting as much participation as we were in June, and that's a bit of a concern when we compare this to the S&P 500 being underneath the 60% of the stocks, and we compare that to the dumb money, smart money confidence indicator above 60%. And this is the reason why we like to take a look at the smart money, dumb money confidence indexes, because it does have a big bearing. When we look at the S&P 500 with less than 60% of its stock above the 200-day moving average and the dumb money confidence over 60%, we notice we have negative expected returns 2 months, 3 months, 6 months, and 1 year out, with the risk reward skewed in the bear's favor. However, if you have the opposite of that, where you have the dumb money confidence under 40%, and you take a look at those same numbers, 2 months, 3 months, 6 months, 1 year out, we have a much higher positive return there out of the S&P 500. Bottom line being, when we have not as much participation and we have retail traders being extremely confident in what's going on, that can bode poorly in the future. Now, again, we look out 2 months, 3 months, 6 months, it's about that 50% mark. So this isn't the end of the world, but when you look against a random assortment of data, this is still below average, which is the reason why we want to pay attention to it. Now, as always, if you guys have any questions, you want to reach out to me directly, you can do so at mtedeschi at perspectivewealthplanning.com, or you can give me a call at 814-580-9881. Hope you guys found this information useful, and as always, I will see you guys next week.